is Murray Wilkinson and my associate is Lili Hong. We're both licensed financial advisors with Future Gen Solutions, a privately owned financial and wealth advisory firm that specialises in retirement and succession planning. In light of the recent budget, we are revisiting superannuation, contribution and drawdown strategies aimed at maximising your wealth potential. Some of these strategies you may already be aware of, while others may well be new. We only have a limited amount of time, so if there is something of interest, please feel free to revert back to us. Now, the first strategy I'll be talking about is maximising concessional contributions. Most of you will probably be aware of this one. There is a maximum cap of $27,500 this year, and essentially that cap is made up of superannuation guarantee contributions, that is contributions made by your employer, and salary sacrifice or personal contributions that you make, which you claim as a tax deduction, known as personal concessional. Now, one of the key strategies to use this year is to maximise the carry forward rule. Now, the carry forward rule essentially allows all of us to go back 5 years and to carry forward those previous concessional contributions that you didn't make. So you can go back over the last 5 years and just remember that the $27,500 cap has only been in place for this financial year and last financial year. Before that, it was $25,000. But you can go back over the last 5 years and you can bring those contributions that were outstanding forward. That means there are some tax advantages in terms of whether you choose to claim them in this financial year, you can bring them all forward and claim them, or whether you hold them over for another financial year. But this is a key strategy which provides you with flexibility. So the second strategy that's always worthwhile, has been around for a long time, but often it gets forgotten, is what's called spouse contributions and tax offsets. Now, the spouse contribution strategy is if you've got a spouse who is essentially working and earning up to $37,000, approximately $37,000, and that's inclusive of salary, wages, superannuation contributions, and possibly fringe benefit tax items, which are required to be reported. If their total remuneration is $37,000 or less, then you have an opportunity to put $3,000, up to $3,000 into your spouse's account. And as a result of that contribution, you would receive what's called a tax offset based on 18%. Now, that 18% converts to about $540. So it's not a tax deduction, it's actually a tax offset. But if you look at it this way, for that $3,000 contribution, it's an 18% tax-free return. So it's an especially good strategy, which is often overlooked. The next strategy is something that many people also overlook or don't think about. It's called the government co-contribution. Now, the government co-contribution is most effective for lower income earners. Could be a working spouse who might be earning up to about $42,000. But it works this way. The government will basically make a contribution up to $500, depending on what your contribution is. So for up to $1,000 that gets put in by the spouse, then effectively the government will, by the end of tax year, the next tax year, add a further $500 to that account. So if you think about it this way, it's a 50% return with not much effort. So well worthwhile considering. Now, the next strategy is called superannuation contribution splitting. And this is one that we use with a great degree of frequency, particularly in the times now where we have transfer balance cap requirements. Now, without getting into too much jargon, we're all allowed $1.9 million tax-free in superannuation. So if you've got a couple, each person's allowed 1.9 million. The issue we often see, though, is you've had a working spouse and possibly a non-working spouse through their careers. So one has built up a substantial superannuation balance, while the other might have a diminished superannuation balance. One might be very close to the cap, the other may not be. So this strategy allows the equalisation of superannuation balances and effectively allows the splitting of the concessional contribution, 85% of the concessional contribution from one superannuation account to your spouse's superannuation account. Very good strategy, allowing for equalisation of superannuation benefits. So that way it helps to assist in not going over that 1.9 million transfer balance cap.
We'll now be sharing second part of the superannuation strategies. Effective from 1 July 2022, individuals under the age of 75 will no longer be subject to the word test when making non-concessional contributions to superannuations. Contributions can be made up to 28 days after the end of the month in which an individual reaches the age of 75. Contributions, the removal of this word test means extended contributions window have significant impact for retirement planning. There is also bring forward rule, which allows individuals under the age of 75 years old at any time in a financial year to make non-concessional contributions. It allows them to bring forward 2 future years' worth of non-concessional contributions and make a larger contributions within a 3-year period. This can be advantageous for individuals who have a substantial amount of after-tax funds available to contribute. Prior to this change, the bring forward rule could only be utilized by those under the age of 67. Let's now look at one case study. So Paul, who is 70 years old and recently retired. Paul has sold some shares and wants to add proceeds to his superannuation balance. Under the new regulations, as he is under the age of 75, he can make contributions to his superannuation regardless of his employment status. Additionally, given his superannuation balance is below $1.48 million as of June 30th, 2022, he can also utilize the bring forward rule to contribute up to $330,000 as a non-concessional contributions. After the superannuation contributions, Paul will begin a tax-free retirement income stream to cover his living expenses during retirement. To summarize this case study, we see that even in retirement, individuals like Paul have opportunities to optimize their superannuation and enhance their retirement savings. Individuals can also utilize their spouse's non-concessional contribution cap to boost their combined superannuation balance. By making contributions to the spouse's income account, they can maximize their overall non-concessional contributions and optimize their retirement savings. By making contributions to the partner's account, we just need to make sure the partner's age is up to 28 days after the end of the month in which the spouse reaches the age of 75. By contributing to the spouse, which means we are able to utilize the amount of money in a tax-free pension environment, which are currently set at $1.7 million each. This cap will continue to increase from 1st July 2023. Will increase to $1.9 million each from 1st of July this year. Let's look at another case study. So Greg and Mary, they are married and they are both 68 years old and retired. Greg has $1.8 million in superannuation, while Mary has $400,000 superannuation balance. Greg can only transfer up to $1.7 million to start his tax-free pension account this financial year. So what can Greg do to maximize this balance is by withdrawing a lump sum account from his superannuation and contribute the $100,000 that he withdraw to Mary's superannuation as an after-tax contribution. Mary can then start a tax-free pension with her $500,000, while Greg can start one with $1.7 million. So both accounts will now be 100% tax-free in the pension phase. To summarize this case study, we see that they have used a strategic approach to optimize their retirement savings by making after-tax contributions from grad superannuation to married superannuation. They can balance their superannuation funds and potentially reduce tax implications. It is crucial for couples to consider the rules and options available to them to achieve tax efficiency to secure their retirement incomes. Now, the most important strategy that we're going to talk about in today's presentation is the recontribution strategy. The recontribution strategy involves withdrawing funds from a superannuation account and recontributing them as non-concessional contributions or any other applicable superannuation contribution strategies. This strategy can be beneficial for individuals who want to reduce the taxable component of their superannuation and potentially minimize tax implications for their beneficiaries. A super account is typically made up of taxable component and the tax-free component. Taxable component, they are formed from using employer contributions, salary sacrifice, and also tax-deductible contributions. So most people in this country, they will have majority of their balance in their superannuation as taxable component. So in the event of the account holder's death, the taxable component may be subject to a 17% tax when it is paid to non-tax dependent, such as your adult children. However, the tax-free component can be paid tax-free to non-tax dependents. But for recontribution strategy, what we can achieve is we can convert a portion of your taxable component to tax-free, which will increase the tax-free component, resulting in potential tax savings for your beneficiaries. Let's use one case study to illustrate how we can do this. So Catherine is 70 years old and retired a few years ago. She has $500,000 in her account-based pension, which is made up of 100% taxable component. If Catherine were to pass away, her adult daughter, Jen, who is not financially dependent on her mother, will have to pay 17% tax on the lump sum, which is equivalent to $85,000. Following advice, Catherine decides to withdraw $330,000 from her account-based pension and make an after-tax contribution of $330,000 into a second account-based pension using the bring forward rule. So now, if Catherine were to pass away, Jen will not have to pay tax on the tax-free component. Jen will only need to pay $28,900 of tax on their remaining taxable component of $170,000. This resulting in a tax saving of $56,100 for her daughter Jen. To summarize this case study, we see that by withdrawing funds from her original account-based pension and making after-tax contributions into a second account-based pension, Catherine has not only optimized her retirement savings, but also minimized the tax implications for her daughter Jen. This also demonstrates the importance of proactive planning and utilizing available strategies to enhance financial outcome and financial tax benefits for beneficiaries.
In conclusion, maximising your superannuation contributions requires a strategic approach. In part one, we covered off the main strategies for maximising your concessional contributions. We touched on personal deductible contributions, carry forward rule, spouse contributions, and the government co-contributions. In part two, Lili focused on the recontribution strategy, utilising non-concessional contribution caps, the bring forward rule, and how to basically maximise the spouse's non-concessional contribution caps. So, to optimise your superannuation strategies, and contributions, it's critical that you actually review and look before year end. By being proactive and leveraging these strategies, you can make the most of the available contribution caps, the tax benefits available, and the retirement savings opportunities. Remember, your circumstances are unique, and by seeking advice, you can essentially optimise your position. In the short time available today, we have presented a number of strategies and case studies. Hopefully, some of the ideas presented will prompt your thinking about your own situation. If you've got some questions or wish to reach out to us, please do so by contacting us either through our website, through our inquiries email, or by direct telephone. Thank you for your time today.